Good morning. This is Dennis Wilburn with the Active Trend Traders. Welcome everybody online. Glad you could make it with this crazy roller coaster market. It's kind of an interesting time. We've got Mike Traeger joining us from Dallas, Texas. We've got Michael Bishop joining us from Zurich, Austria, and Switzerland. Okay, gosh, sorry about that. I knew that, but
I'm Austrian, so
that's where fine. It comes in. Okay, Mike Traeger, how's things in Dallas? You guys still getting rained on?
Yeah, getting rained on. It's been a pretty wet week.
Yeah, it has out here in California also. It's been the Pineapple Express came in and has brought a lot of weather with it. We're working on doing some painting around the house, and let me tell you, when it's humid, the paint just doesn't dry worth a darn. I want to remind everybody that what we present on these Friday webinars is for trading purposes only. Traders should always paper trade any new method prior to the risk of their own personal capital. Here's Michael's disclaimer from Europe. Again, indicating this publication is for your information only. It is not intended as an offer or a solicitation. At the Active Trend Traders, I get emails from our members all the time basically saying thank you so much for the training. We get, and so is it great in Oklahoma? Tracy, is it raining there too? This past week we did a presentation on the active trend trading oscillators that we utilize. And of course, all our training is posted to the website with the presentation slides. This coming week, we're going to be, over the last 3 or 4 weeks, we've been doing a building type training sessions where the individual parts are being, basically filled in, so that now in the next couple of sessions, we're going to be doing the convergence of clues and then bringing it all together. It's, one thing with technical analysis, it's a continuous learning process. It's a continuous refining process. Matter of fact, I'm going to do some training I'm going to get some training this weekend. I introduce that to our members, any training that is worthwhile that I receive. So March 16th, which is next Wednesday, convergence of clues. Excuse me. So last week, I was asking a question, is the relief rally at the end of its leash? And the relief rally continued to move higher slightly. And so this week, while we are pushing out the new highs on the S&P, or new highs for this particular relief rally, the price action is somewhat muted. It seems like we are in a holding pattern, getting ready for the Fed, which reports out next Wednesday. And it's kind of a, we're seeing a draw between the buyers and the sellers. The S&P is drifting higher. NASDAQ is at resistance. Russell is basically just off the 8-day moving average. And some of the influences, I'm glad Michael is joining us from Switzerland today, because I'm going to chat briefly about the ECB. But the head of the ECB, Mr. Brackey, gave a speech yesterday. The ECB says basically they're going to continue to be very accommodative on their rates. Their overnight borrowing, they increased it to the negative side. And so some of these other things are influencers of the market. Each could be potentially a catalyst for further upside. We'll see. I mean, or it could be a snowball effect. And so Scott makes a comment. He says, you keep calling it a relief rally. When will you put your bear suit on eBay? Maybe as soon as the S&P takes out the previous highs from last year from a technical standpoint, because that's when it would be considered, or not the highs, but close to the highs of last year, or last December. that's when it would be in a confirmed new uptrend. Scott, right now we are still working, and when we see the charts, you'll see it. We're still working within a downtrending channel. But some of these other things could be influences into the markets. Michael Bishop, you made a comment that basically said that Brocky's statement and all that kind of stuff gave a little bit to everything, so it kind of made the bulls and the bears happy. Is that what you meant?
Yeah. So especially how the market reacts. I think he promised more than expected.
Yeah.
But at the first move, the market really went down.
Yeah, it did. Yeah.
Interpreted that the market doesn't believe in all the actions.
Yeah.
But on the other side, when the European market was closed, the US market then rapidly moved from the negative side to a very bullish side, continuing today.
Right.
So everybody is a little bit confused on the one side, and on the other side, there is some arguments for everybody to be right.
So, Mike Traeger, you'd made a comment. You had, in some of your research, had found that what's his name? Draghi had made a comment that this was the last trip to the trough.
Well, from the reading I've done since yesterday, I mean, I didn't listen to his announcement or any press conference or anything, just, from reading about it. But apparently statements after the announcement that, they're done with all this, quantitative easing and cutting interest rates and, everything that goes with it, that they've basically, shot their wad, so to speak, and they're done, and there won't be any more of that kind of thing coming down the pike. So to see how the market's doing today after, that kind of verbiage was put out yesterday is a huge surprise to me.
Now, was the essence of his comments basically an indication that, well, that's because things are, appears as if things will get better after we complete this action, or was it just that, hey guys, we're out of money, we can't do this anymore, the debt's growing? Because I see, all three of these things, and I'll let you answer that question. Market oil producer meeting on the 20th of March, where they may basically try to control the supply of oil. But what was that covered in the article regarding?
Well, yeah. From what I could glean, and that's a good question to ask, and from what I could glean from the reading, it was more along the lines of, we're out of ammo.
Okay.
Not so much because he thinks the economy is doing great and isn't going to need any more help, but we've basically, more along the lines of we've done everything we can do, and that's it.
Okay. And so I mentioned in the oil producers meeting on the 20th, and so the next 3 weeks, on the 16th, we have the Fed meeting and report out regarding interest rate expectations. The market is basically pricing in that the Fed will not raise rates, and that the Feds may, they've been bantering around this concept of the Fed going to a negative interest rate, just like on the overnight lending, just like the Europeans have. But somebody made an interesting, maybe it was you, Mike, who made an interesting comment about that it may not be legal for the Fed to go to negative interest rates without congressional approval.
Yeah, it was me that made that comment, okay. and that's a very real thing. I mean, that needs to be sussed out. Yellen has made the statement that she herself is not sure that they have the legal authority to go negative on the federal funds rate. Without that, the rest of it is just pure talk and conjecture.
Yeah, and so, but anyway, something to keep in mind. Short-term uptrend, and we are continuing to be in a short-term uptrend within a longer-term downtrend. We'll see on the charts here shortly. One of the interesting things is, who knows? Maybe they'll do um, a presidential executive order so they can bypass Congress. I mean, I know it'd be a shock if the current administration did that on anything, but maybe that's how the Fed gets around going to Congress. So so is Yellen joining the reality TV show as Trump? And then Scott makes a comment, Draghi pledged to flood the financial system with fresh liquidity for as long as it takes to keep the fragile economy recovery alive and prevent a deflationary psychology from taking over. Yet there was a sting in the tail. Interesting.
The only part of me that would like to see Trump become elected president would be for him to be able to say to Yellen, "You're fired."
Okay. So on the stocks, percentage of stocks on the NYSE that are above the 20-day moving average. Last week we were approaching and hitting some highs that we haven't seen in quite a while, in well over a year. This week we actually topped out about 90 and then started to fall. Mike and I have addressed that this particular indicator is better at predicting bottoms and turning points than it is per se predicting turning points at highs. But we know that this is an extreme, and you can anticipate prices, stocks to be basically selling off from that, taking profits off of that. And so while yes, we are above the 80 level, and it popped back above the 80 level a little bit today. We'll see where we, if we kind of hold up here for a while. Again, this chart becomes most interesting to us when we're down here below the 30 level. And you got any comments on this one, Mike? And there's not a lot to...
Yeah, there's really not a lot to comment on. I think it speaks for itself. For this to have gone up to 90, it was really extreme to the upside. That again, as I've said before, things can get overbought, but they can stay overbought. And last several days, I think that's what we've been seeing.
Yeah, and one of the other things is, got to remember that this move here, this is this move from 212 to 11. This is 211, all the way up to here on the S&P and on most of the indexes was done in below average volume. And so I know there was a lot of discussion, especially on IBD and some of their commentation is that while this, you had this, nice big rally, the institutions weren't really jumping on board yet. And so what we may be seeing is just the overflow or the reaction to a lot of people starting to fund their 401ks, their IRAs, and all that kind of stuff going into the April timeframe for tax purposes. I like this chart. Basically, it is the monthly percentage, same basket of stock, but it's those that are above their 200-day moving average. As you can see, it is lingering down here. We pushed up a little bit from where we were last week, up about a little bit over a percentage point. And so imagine, picture in your mind that what this is depicting is that, one, the 20-day moving average has gotten way extended away from a 200-day moving average. And now the majority of stocks on the NYSE have made it back above the 20. There's still a ways to go for them to get back above the 200. Now, I know that, and this is for either of the mics, is that some technicians want their price action back above the 200 before they even consider that it's potentially going back in an uptrend. Is that correct?
That is correct, because one of the definitions for some people of individual stock or an index in either an uptrend or a downtrend is whether it's above or below its 200-day moving average.
Correct.
And what's happening today, and it's been happening for the past couple of days, at least with the S&P, is that it has been below its 200-day moving average for some time, since about December, and it's beginning now to bump up against it, coming back to it from having been below it. And that is happening today in real time. So the question becomes, is it going to break through and then start a run above the 200-day moving average, or is this going to be the absolute resistance that makes it turn around and go back down?
Right.
We just don't know yet, but that's what we're seeing happening today.
Okay. And so, hey, Michael Bishop, do they have a similar type of index that you utilize for the European markets?
No, there's nothing available.
Okay, you got to stand a little bit closer to the mic, man. I can't hear you.
Sorry. No, there's nothing publicly available.
Okay. So, okay.
I mean, I think it's now worth mentioning that I mean the US markets are so much better covered and also so much more liquid. I mean, I know funds that that have poorly European stocks, and they go to the US market to hedge it because it's just more liquid, or in the other way around.
Okay.
There is more appropriate instruments in Europe.
So they kind of do like the similar thing to what the Chinese do with some of their stocks in their market. They basically set up an ADR or something like that, and then that's what's actually traded on the U.S. stock market. David Trujillo just said that the SPX just touched the 200-day moving average and fell back about 20 minutes ago. So here's where we're at. As of about 9 o'clock this morning, the markets are still down for the year. They are also. We're also tracking how far they have fallen from the high of last year, which was that's the key point that we want to keep watching. And as you can see, we haven't made a lot of traction since last week. There's been a lot of big ranges on some of the indexes, but if you go down here from the NASDAQ Composite, Russell, and compare that with what took place last week, it basically hasn't moved that much. The S&P and the Dow, of course, we've been talking about how the S&P is the strongest index of the tracking indexes that we watch on a daily basis, and it's still showing that. It's showing that in today's price action as it's moved up, and as David said, just hit off the 200-day moving average. And we'll see what kind of a fall down from there it takes. Let's take a look at the charts. There we go. And there is the 200-day moving average on the S&P. This is a daily on the left, weekly on the right. We identified. Let's go over to the weekly chart, and if you connect the highs, the previous highs on a weekly chart, and then actually just copy that line and transpose it down here, we can see that the S&P is working in a downtrending channel. This is what I was saying, Scott, is with respect to lower high, lower low, and we're still working within that. So while yes, we've had a nice little run back up, will it get up here to this level here? We shall see. We know we have, that's up at the 2050 level, which actually is about the target. If you measure from this high to these lows, it puts it up somewhere about the 2050 up to about the 2075. There's a lot of bets out there. I was talking to my future brother-in-law, and his financial advisor is telling him that he doesn't expect the S&P to go much above 2030, maybe to 2040. And I told him that our target is somewhere, if it does continue to go up, that we're looking at somewhere between 2050 to 2070 as a place where it may potentially turn around. The market needs to take out, the S&P needs to take out these highs before we consider it back. Well, take out those highs, put in a lower low, higher low, excuse me, and then bounce back up and take them out again for it to be considered in a technical longer-term uptrend and reverse this downtrending channel. So what are we seeing here on the, it was kind of interesting. Last week as we were making these highs, as you see, the momentum on the daily chart was actually falling. Now we get a spike up in momentum today as price action pushes up. We'll have to wait for the end of the day to see what kind of volume that this move is reflected of. Again, we are still working within, I had identified last night basically a trading range that was about there. And as you can see, we're breaking out the top side of it. And so this upper side of the trade range did not hold. So this swing high here has been voided, and we are still in the context of this uptrending short-term, uptrend, the uptrend within the context of a longer-term downtrend. We have a nice little trend line going here now, so we'll see if that's threatened at all going into next week. And we can just anticipate, I think, let me get my other pencil. We can anticipate basically the market kind of maybe hanging around there where this will, act as this, about 2065 level will act as a really good level of support. If we, we'll see where we close today. If we break back down below this high here, that would be considered a failed breakout there. So Mike, either of you guys, any comments on the S&P?
No, I have no real comments beyond what we've already covered, I think.
Okay. One of the things that is interesting about on the daily chart is while we are maintaining, waiting for the Fed and all that kind of stuff, look what we have going on here. I'm surprised you didn't call this out, Mike. No.
Well,
it's not much.
Yeah, I mean, I saw that, but it hasn't turned over yet. So,
yeah.
Every time a divergence like that is happening, it tends to not play out until you actually see the turn.
Yeah, exactly.
I think the one comment I do have, we talk a lot about using the 8-day EMA as a trigger to either get into or get out of position.
Right.
And once the S&P turned here in February and got back to its 8-day EMA, even despite some of the big days with big intraday volatility, on the close we have stayed above the 8-day EMA since mid-February.
Exactly.
For most of this rally.
Yep. And so, okay, let's take a look at let's take a real quick look at the as long as we're here, let's take a real quick look at the monthlies. Again, on the monthly chart. Again, we have been looking at this from the aspect of what it looks like back here in 2008. And we are back above the moving averages, same way we were in May of 2008, and waiting to see what's going to transpire here. We've got this upper ceiling, slanted ceiling from the upper upside of the downtrend, upside of this downtrending channel. And so that's a target for potential resistance, but almost like this whole area from the 8-month moving average all the way up to that is a resistance zone where we could anticipate a turnover. Dorothy asked a question: any money inflows from Europe's negative interest rate helping the market? I don't know. Michael, are you aware of Europeans trying to get their money out of Europe and get it into the U.S. market?
Hard to say. I don't know actually.
Okay.
I mean, if you look, yeah, I think these 2 days were really hard to make any good conclusions.
Yeah. And that's why it's also, that's a great point. And I know that Mike Traeger and I talk a lot about is, when we get our close today, one, the monthly isn't over yet. It's got 2 more weeks, almost 3 more weeks of March to be completing. And at this point, ever since we get this hammer back on the S&P, back mid-February, we've had nothing but, good up weeks. And there has not been a week that is closed down to provide a potential bearish reversal signal. That hasn't happened during this move to the upside. Although this week it is a little bit shorter than the other weeks, and so is the momentum coming out? I don't know. Mike, you got a comment on the longer term charts?
Well, yeah, as I've commented before on both the weekly and the monthly charts, I mean, what we've been seeing going on here, if we go back to the peaks in the market last, May, June, July,
right?
The bigger picture perspective is that we've put in a series of lower highs and lower lows, and we have not come back to take out those highs yet, nor are we close to doing so.
Right.
And there's a lot of different ways to define an uptrend or a downtrend. Lower highs and lower lows is certainly one commonly accepted definition of a downtrend, and by that standard, the market has been downtrending since last spring for a good 9 or 10 months now. Until proven otherwise. And in order to reverse that downtrend, in my opinion, we're going to have to go back up to above the 2100, 2150 level and put in some definitive closes there.
Right.
And then this is still a downtrending entity, according to that definition.
Yeah, and at this point, it's a downtrending entity, but it's not giving us any, at this point, not giving us any setups to take a trade back to the downside yet, especially with the action of today, because we were looking at, we'll see the NASDAQ here shortly. But we were stopped out of just one bearish trade that we were in earlier this week. It just came down and it looks like it's hitting off support, but that was on the SQQQ, which was the NASDAQ invert leveraged in invert. What am I trying to say, Mike?
What, inverted hammer?
SQQ, which is the inverse of
SQQ is the inverse.
Yep.
Leveraged ETF for the NDX.
Yeah, and for those who have been trading along with us on that particular trade, it's very interesting. This is one of the things I talked about, is that because of how they form this leveraged entity, the inverse index ETF, especially the leveraged ones, have a tendency to actually lose value a little bit on a daily basis because of how they have to readjust it on a daily basis to match the three times leveraged what they're trying to do, and it will not necessarily coincide exactly to what's going on with the individual index, because the index, like I said, like here's the NASDAQ, it hasn't quite hit, back up here to the high it made a couple of weeks ago. It's hanging right there below on the weekly chart, below the 40-week moving average, which is approximately a 200-day moving average, and but the value of the SQQ did in fact fall off a little bit and hit a stop loss. And it's just, but you still have to, trade by the rules, because if you don't, it will come back and bite you. But that's one of the nuances of trading those inverses. So what do you got going on here on the NASDAQ? I think the NASDAQ points a much better picture of trading within this range. And as you can see, while the S&P has gone on today and kind of get a nice little breakout, at least it is right now, the NASDAQ is still trading within this trading range. And it's not breaking out. And what's interesting, I find it very interesting, is for about the last 7 to 8 days, we've had these small body candles, which are indicative of spinning top dojis or hanging men type dojis, which is indicating that the NASDAQ is pausing right here. Now, if NASDAQ does blow out through the top of this, then we're probably going up to the 200-day moving average, but it's considerably below its 200-day moving average, and it may go ahead on up here to the 4,500 level, or it may stop right here, reverse down, but in the interim until the Fed meets, I think that there's a good chance it'll hang out right within this trading zone, the range here, and just kind of hang out there. On a weekly chart, if we close where we are right now, the NASDAQ is putting in what's called a hanging man. Now, it did that a couple of weeks ago. This hanging man was voided, but that is a reversal candlestick pattern. And so if it, like I said, if it closes right now, that would be a hanging man, which is a bearish reversal signal. However, if the high is taken out, that would indicate that voids that particular signal. What do we got going here? Mike was talking about, again, momentum was falling off as we were making this move here, It ticked back up today as we gapped up back into in this case, the 100-day moving average. And we're approaching the zero line on the weekly chart. And so oftentimes what we'll see is we'll come up here, and if the weakness in the market does reoccur, we can stick our head above it and then bounce back down. And then we would be looking over here for a potential positive divergence, because part of what one of the things articles you sent me yesterday, Mike, was also saying that this particular guy was calling for a market reversal back to the upside in the mid-May timeframe.
I don't remember seeing that.
Okay.
But you might be right.
Yeah. And that would, if this pattern does work its way back down and then hammers around over here, that would put it about May timeframe. And all the guy is doing is basically the same thing we do, any technical analysis guy. They'll measure up, or they'll take this downtrend here, and they'll take this same downtrend. Once we get the reversal, they will then just extend it on a similar trajectory, approximately, and then wherever it crosses these lines, that's where they can say, okay, this should take about this much time. And it's uncanny how often that works out. So the NASDAQ, is basically not as strong as the S&P. Let's take a look at the Russell. Okay, Russell. Russell's actually a little bit stronger than the NASDAQ, but it needs to pop up above the 100-day moving average. It has put in a swing high. And as you noticed also that on both the Russell and the NASDAQ, the swing highs are, they were not busted today. So as long, as we're working within this range here, it can bounce around, may not have much movement between now and next Wednesday. We will see. If we close today where we are, you will have basically almost a dragonfly type doji or a hanging man type doji, which is also indicative of a bearish reversal signal. Again, we had the same type of momentum falling off. Now we're making a little bit of a turn, and we'll see what happens, and we'll just be watching to see what both the TSI, what the momentum does, if prices on the Russell push back up towards the 1094 level. Okay, any comments, Mike or Michael, on the indexes?
Well, my only other comment, and it applies to all the indexes, and it took a lot of energy for the market to do what it's done here the past month or so, and I think, and certainly I thought it yesterday before today's action, the energy needs to be replenished, and the
Right.
market would be likely to sort of consolidate here for a while to build up energy for the next move, whether the next move is to go up further or to turn around and retrace some of this gain.
Right.
It just seemed, and mostly from those candlesticks on the NDX chart, on the daily chart, it was just getting kind of tired.
Yeah, exactly.
With multiple days of doji type candlesticks without a lot of either advance or decline. So it wouldn't surprise me at all to see some stalling action here for a little while. And keep in mind with the Russell and the NASDAQ, both of these indexes are still well below their 200-day moving averages, which are, declining. And again, according to that definition, despite the last few weeks, still in a downtrend because they still live below that 200-day moving average.
Exactly. So, one of the other things that just to kind of keep in mind, if you are new to candlesticks, a lot of people make a huge mistake thinking that a doji, that's basically where the close and the open are approximately the same. Some of them are, doji type, slash spinning tops. They think that that's a reversal candlestick reversal signal. It is not. What it does is basically it communicates to the technician that as Mike was saying, the current price move has run out of energy, and basically it is a candlestick of indecision. It means it's pausing, it's waiting, it's basically digesting gains, or and then once you start to break out from that, the decision has been made, and that's typically the market will tend to go in the direction, not 100% of the time, but tend to go in the direction that it breaks out from the doji. So I'll just pass that on for everybody who does is maybe learning how to trade candlestick. So I got a couple of questions here. Yeah, Eric had said that we had called it and saying that last week's or that this week's price action would probably pull back to about the midsection of last week's candle. That's exactly what happened. And then so that happens quite often. So that's why the midsection of these big candles are good areas to draw a line like this, and then see what it tells you over here on either a daily chart and or an intraday chart, because you can bounce back to the intraday chart to also say, okay, hey, I came back to that point, and on the intraday got a reversal signal. it's time to get long. So.
You know, and going along with that, if we look at the weekly chart of the Russell here,
yeah,
and you know the high that the Russell has put in this week, and we look at the midpoint of a big bearish candle that was put in, back in December or the first week of January, it looks like, and right around that midpoint now is where we have, you know, some potential resistance anyway that, you know, seems to be holding for now.
Exactly. So. Okay, cool. Hey, way to go, Eric. That was thanks for having a good memory. So what's the path of least resistance? I think until after the Fed meets, we're basically going to be a holding pattern with a bias to probably try to move up a little bit more, or it may have hit the ceiling today and said, hey, I'm not going to go any higher than this because it would change the technical dynamics of the market. Longer term, until proven differently, longer term, and again, we're not saying the market's going to, you know, turn around and fall next week out of this short-term uptrend, but we're still working in the context of a longer-term downtrend. So the big thing that we've been doing over the last for almost all year is basically just collecting premium on strategy number 3. This $395 was the drop on the SQQ trade. So we're up a little, you know, cash flow, I'm really pleased with where we're at given the conditions of the market. Strategy number 3. Again, on the cash flow that is generated is up about 25%. Strategy number 1, I'm not unhappy with that because the trades just didn't, you know, the individual entities didn't work. And when something doesn't work, you fire it. So cumulative, we're doing, you know, we're doing okay, better than the markets. And what tends to happen, is, you know, when you do an equity chart, you'll get these basically where you'll kind of go around like this, then you'll pop up, then you go click it, then you'll pop up, and eventually throughout the year there will be a trading environment where you get these bigger pops, and then you go sideways a little bit more, and hopefully you get a bigger pop to eventually sometime during the year overtake. And this is my 40% line on the 100,000 that we start the year with, and eventually you overtake the line. But and then sometimes this line actually goes down and then back up and down, and so but we want to keep a track of what's our equity doing and make sure it is in fact moving in the right direction. This was from last week. Mike did an excellent presentation on how bull markets die, and all these other things have been put into place. So if you're new to today's webinar, or you're listening to the recording of this, the active trend trading system, we work off the 5 pillars of active trend trading: what to trade, top quality IBD stocks and our index ETFs, when to enter, when to exit, what strategy to use, and what to expect. And oftentimes I've seen so many people try working on strategies without having a good system in place. So we have a great system, then we work on these particular strategies. And to be forthright with it, it's been a tough year trading. Mike, you've indicated that this year's been a choppy year for trying to trade, and it's nice that we have that strategy number 3 that keeps cash coming into the account, and I really like that. So if you are viewing this, we do offer a discount for membership for people who take the time to watch the video, and so appreciate that. So that's all we've got for this week. Mike or Michael, any final comments before we look at some charts?
No, I really can't think of anything else.
Okay, Michael?
Yeah, maybe one comment. I mean, very interesting to see is how strong TLT, so that's the bonds, the 30 years bonds,
right,
gave up. That could be.
I'll take a look at
that's maybe for me the kind of the chart of the week. And gold and gold miners, oil, all this commodity related stuff seems to have reached the upper limit for a while.
So here's TLT. Now is TLT measuring? Okay, it is not the inverse. It's the direct on the U.S. Treasury, right?
Yeah.
And then gold, either GLD or yeah, looking longer term, it's moving into resistance here. Now it was a nice move from down here, back up to this area here. You got about a 17, 18% move, but it does look like it is also stalling out. You've got the TSI starting to turn over. This would be a hanging man today, and it's back up into a resistance zone. So good, interesting.
And GDX, these are the miners, looks very similar. And maybe oil on a very different level, but seems also to need a little rest.
Okay.
Yeah, I think oil needs a rest. You know, from the the absolute low back in February, which correlated with the absolute low in the equity market indexes to the high price of the oil futures today.
Yeah.
From low to high, oil has moved 50%.
Oh yeah.
Like a
Yeah, it's absolutely amazing. One of the other things that I track is, let me get this up. I think this is it.
Sorry guys, it's 7:45 and I have to leave.
Okay, Michael, thanks for joining us, bud.
Great weekend. Thanks for having me. Bye.
Bye. I'm looking for, there we go. I think this is it. One of the other things that I keep an eye on, Mike, is this GLOG, and it's a pipeline trade, oil pipeline. But look at the move that it's made. From this low here up to this area here. It is oil related, but it is getting very overextended, where we'd anticipate a pullback. And so, okay, guys, let's look at some individual stocks. This GLOG, G-L-O-G, it has really good option, open interest, and it's I think it's an interesting entity to keep an eye on. It's an ETF, but it also actually pays a dividend, and so it's GasLog Limited. So it's not an ETF. It's that's the name of the company. It's fun to watch. Mike, have you ever traded GasLog?
No, I wasn't even really aware of it.
Yeah, it's so let's see.
The only ETF I know for natural gas is UNG.
Yeah.
Which for years now has just been a nightmare to get involved with.
Oh yeah.
Yeah. Hey, before I sign off for today, Dorothy made a comment here a little. And it was a very smart observation, I think, asking about whether money would be flowing maybe out of Europe into the U.S.
Right.
Given everything that's going on, and how that might be affecting the equity markets. And my feeling instinctually is that if there is some capital flow out of Europe into the U.S. markets, it might be more in the bond markets.
Yeah.
Because with the negative interest rates in Europe, the bonds are being affected. They're not paying really any interest, and
right.
Some of the shorter term bonds in Europe are actually negative now. And at least in the U.S., you can still get a mildly positive rate of return on treasuries, and so I would imagine that could maybe help support the bond market more than the equity markets.
Yeah, and so yeah, that's a great point. That would potentially be bringing dollars into the U.S. One of the things that I wanted to indicate is we have the ECB, we have the Fed, we got the oil. Those three catalysts, which could turn out to be exceptional market movers, or and that's where we got to take a look on the flip side of that. depending on how they're interpreted by the the big institutional guys, it may also work as a snowball effect where people would go, you know what, this, they shouldn't have to be doing this kind of prevention in a healthy economy, because I see stuff all the time about how healthy the U.S. economy is, and so I'm not going to go and talk bad about that, but the thing about it is what's communicated out there for the general public and what is perhaps actually going on behind the smoke and mirrors is that they could be really quite concerned. I just hope they're not foolish enough to think, but I think they do think this, that what they're doing is going to make a difference. Like you said on Wednesday night, Mike, the true, the definition of insanity. We may be seeing it worked out, in our own, with the Fed right now. So
yeah, well, my one, and that's really a good thing to note. My one parting comment on all of this, I mean, if you look back at the U.S. economy, and you go back 100, 150, 200 years, I mean, the economy goes in cycles, and there have been recessions and little financial panics before, and the U.S. economy has always managed to find a way to recover. And thrive and find its way back into an expansionary cycle,
right,
without any help at all. And why are they fooling around, the way they've been fooling around now for a few years with this one, when they've never really had to do this before, certainly to not these extremes, and there has always been a recovery coming out of a down cycle.
Exactly.
Why did they think that these kinds of extremes are necessary for an economic recovery?
Yeah.
Why is it different this time than it was the last 200 years? It's kind of a rhetorical question. I don't have an answer to it, but from that perspective, you would think that a lot of what they've been doing might actually have been hurting things rather.
Yeah, without a doubt. I mean, we both know for certain that this economic cycle that normally rolls along like a little sine wave, and various things happen within it to help prop it up, help drop it down, and all that kind of stuff. But it's almost a natural occurrence kind of thing. This has been the most interfered with by our federal government, and the central bank, most interfered with recovery that we've ever had. And so one could, I think, make a case that because of that, and because of new government regulations, all that kind of stuff, the rate of recovery has been definitely below where it was. Hey, I got to look at some charts here, man.
I'll talk to you later.
Okay, thanks, Mike. You're awesome. So MHI. This is why it's important to look at both a weekly chart and a daily chart. On a daily chart, it appears, okay, we are hitting at up against a high. Well, it has this swing low here, which is a natural level of resistance. If you're already in this trade, let's say from down here, then that may be a place where you might want to take some profit off the table, and or if it breaks back down through the midsection of this large candle that it's putting in today, that would be also a good place to put in some, take out some profit. If you're not in this trade yet, you're going to want to see some kind of a pullback into and this one appears like it likes to trade in trading ranges. Wait for it to pull back into a new trading range, or just stabilize in a new trading range for its eventually break back up through that level of resistance. So that's, let's see, what else was that? MAV. Okay, and on each one of these, like MAV, these are muni it must be utilities. Utilities tend to be a defensive type stock, if that's what this is, and so it actually went way high last back in 2014, went sideways, fell out of the sky, and is on some kind of recovery here. one of the things that I look at this and, what's missing, and this is why I wouldn't even look at an entity like this, is what's missing. And what's missing are my moving average envelope, which immediately, since they don't show up on, it's 25% on a weekly chart and 10% on a daily chart. This is telling me that over the last, going back through, into 2013, the weekly moves on this haven't even come close to the 25% or 20% envelope away from the 20-week moving average. It's telling me that it doesn't move a lot, so it doesn't categorize and fit into my lens for a growth stock. And so I would basically say, this would not make the cut list to move on to be traded, that I'd want to be trading. Please review. They pay dividends. Yeah, Gino, and that's, they probably pay really good dividends. But again, I mean, you can apply the same rules to them, all that kind of stuff. But this is like I said, a defensive type trade. Double check our time here. We're going good. So IP Whirlpool. Okay. IP. Okay. And here's those moving average envelopes that I was talking to you about, on both a daily and the weekly. IP, which is International Paper, again, a defensive type stock. It's actually making a nice little move up off of a bottom here. Longer term, Scott, it has broken through this. Oh, don't do that. It is broken out of this downtrend that has been in place for since about April of last year, and now it looks like it wants to move higher. After some consolidation, you've got earnings coming up on 4/27, but again, I would need to run the stock checkup on it to see what kind of fundamentals it had. But from a technical standpoint, hey, you're getting what the first indication that it's wanting to break this longer term downtrend, which is a good thing. They also pay, so they pay about a 40-cent per quarter dividend. Whirlpool, again, similar type pattern. As we saw from the previous stock, International Paper, again, it has broken back up this uptrend. I mean, this downtrend has now been broken. When you take out this high here, that will set us back in for, you've taken out a lower high to be considered in a more intermediate type uptrend, and it's getting some good volume coming back in. Again, I would want to be taking a look at the stock checkup on Whirlpool. Let's see, Google. I didn't write that down. I should say Alphabet, the stock formerly known as Google. In an uptrend, it is a big mover on a daily basis. So we are breaking back above the 8-day moving average. It appears as if, where's it likely to go? Probably back up and at least retest up at the 800 level. That's on what we're seeing from a weekly chart. Good reversal down here. Momentum starting to come up. And it needs, on a daily chart, this is where you see this other hidden level of resistance right here. It needs to break and close above that, the midsection, the high right there, and then that will revert and become a level of support. So again, might get a nice move. This was earnings related, this drop from the sky, but it fell right down to right here to the, where did it fall to? the 40-week moving average, which approximates the 200, but as you can see over here, it stayed well above the 200-day moving average. And now it's trying to work its way, back into a potential uptrend. Or at least to go back up and challenge the highs from previously. Facebook. Facebook has been really, how do you want to say, a interesting stock over the last few weeks and months, and that we get this big uptick after earnings, went up, hit the new high, fell back down. Then we went on this uptrend here, which is on a little bit of decreasing volume, hit the high at 110, reverse back down, fall to 105. Tracy, for me, looking at Facebook, I want to see what it does here. Because what we've got going on is we do have at least if it gets back here and we still have the TSI below this high here, then we'll have some negative divergence. Same thing on the momentum. And really, when the momentum starts to do that kind of just jagged type pattern, often that's almost like a doji. It's a lot of it's a lot of indecision and not really strong directional, not a strong directional trade at that particular point. And we're seeing a little bit of that here also because we're getting just zigzags. So, okay, guys, with that, we're going to call it a day. I want to thank everybody for joining us today. I will. One more. George brought up one of the stocks that I'm really taking a look at. I will share two stocks with him that I am taking a look at. PayPal is one of them. It needs to do some nice little pullbacks to get us into a potential trade on this. As you can say, on a daily chart, it's a little bit, large range, but it looks good. I mean, PayPal is a company that I think has some very good potential. But let's see what it does when it breaks, either breaks out or retest. If you're looking to get into PayPal at the strongest point, we're going to wait for it to pull back to the 8-week moving average. And so it may take a couple of weeks. You may want to look at somewhere between the 8 and the 20 on a daily basis, but it has started to swing back up. However, this little sideways move of indecision, it's been done on low volume, so the sellers aren't really jumping in to say, hey, get me out of the stock. So I like PayPal. The other one that may be setting itself up for a little bit of a pre-earnings run was doing pretty good. Earnings are on this is Nike. Earnings are on the 22nd, which is in 2 weeks on Tuesday. It reports after the market. If we can get some movement where it kind of just hangs around in here or even comes back and maybe retest in this area here about the 58, somewhere between 59 and 58, and then retakes that level, that may be a good indication to get into Nike for a pre-earnings run. Got positive. The true strength indicator turnaround hasn't broken yet, and we got a little bit of positive divergence on the momentum as it's popped back up over the last 2 days. Yesterday's pattern was a hammer that also doubles as a bullish harami, and so, but look where it runs into resistance today, right where we would expect it to, right at the 50, 200. This jumble of moving averages is where it kind of just hit the brakes and stopped. So with that, we're going to call it a day, folks. Have a great weekend. I'm going to be plastering walls and also painting and doing a whole bunch of other things. But we'll get the Traders Report out on Sunday. Have a great weekend. God bless everybody.